Welcome to our channel. Have you ever wondered why so many finance people are talking about WACC? What is WACC? Today, I'll talk about WACC and its applications. WACC stands for the weighted average cost of capital. It represents the minimum return that a company must earn on an existing asset base to satisfy its creditor, owner, and other providers of capital, or they'll invest somewhere else. This is how WACC is calculated. Basically, WACC is calculated by taking the weighted average of all costs of funding. In this diagram, we have three sources of capital: debt, preferred share, and common share. Debt is the money borrowed from a bank or any other type of investors or by issuing bonds. Common equity is the money raised by selling shares of the company, for example, IPO. Preferred share are the shares of a company with dividend that are paid out to shareholders before common stock dividends are issued. To calculate WACC, you simply take the size of each source of funding and divide by market value of all outstanding securities, and then times the required rate of return for that specific source. Finally, add them all up, then you get WACC. WACC is mainly used in two situations. First, it is used as a discount rate in the discounted cash flow approach when we evaluate a company. Second, it is also used as the hurdle rate for investment decision. That is, if the project has a lower internal rate of return, aka IRR, than its WACC, then we should invest in this project. IRR is the break-even rate of return for a project, and WACC is essentially the cost of this project. If your return is higher than your cost, then you'll make money by investing in this project. We'll talk about IRR in our future video. WACC is different for each sector. For example, WACC for the technology sector is around 50%, but for the energy sector is only around 6%. That's because we need to consider all different characteristics of each sector, such as business risk, financial risk, and tax treatments. And WACC also depends on investment horizon and opportunity cost. Long-term investors can use the S&P 500 index return as their approximation for their WACC. Even though WACC is a very important concept in finance and it's taught in every business school, Warren Buffett once said in his annual shareholder meeting that he does not know the WACC for his own company, and he has never seen a WACC calculation that makes sense to him. That is because every investor has their own opinion of what kind of factors should be considered into the calculation of WACC. In real life, WACC is closely related to return on invested capital, ROIC, and treasury yields, because if we look at the formula for WACC, the most important inputs would be the required rate of return for equity and for debt. ROIC is an estimation for required rate of return on equity, but of course it's more complicated than just that. And treasury yield is directly related to the cost of debt. We'll talk about these two concepts in our future videos. Now this graph shows the WACC and ROIC for S&P 500 from 04 till now. The solid line represents ROIC and the dashed line represents WACC. We can see that these two lines are positively correlated to each other, and WACC is also correlated to the 10-year treasury yield. A firm being able to consistently earn an ROIC greater than its WACC is an indicator of a strong economic moat and of the firm's ability to sustain its competitive advantage. Meaning that if the ROIC is greater than the WACC, then value is being created as the firm invests in profitable projects. One thing to keep in mind is that capital markets has two sides, the sell side and the buy side. The sell side are the investment banks and the buy side are the asset managers. From what we have learned today, WACC as a discount rate, it has a negative relationship with the asset price, meaning the higher the WACC, the lower the asset price. The lower the WACC, the higher the asset price. This creates a natural conflict between the buy side and the sell side. Investment banks want to sell product at a higher price so they can make more profit, and asset managers want to buy a product with lower price so they have a high return. So a lower WACC is beneficial to the sell side, and the higher WACC is beneficial to the buy side. If you have any questions regarding this topic or have something that you want us to talk about in future videos, please leave a comment down below. If you enjoyed our videos, please subscribe and smash the like button. You can also follow us on Twitter or visit our website at www.ironhawkresearch.com. We'll be posting weekly market commentary and articles about things that you might want to know in finance. Thank you very much for watching and see you next time.